Good evening, ladies and gentlemen. A very warm welcome to ICICI Lombard General Insurance Company Limited Q4 and FY 2025 earnings conference call. From the senior management, we have with us today Mr. Sanjeev Mantri, MD and CEO of the company, Mr. Gopal Balachandran, CFO, Mr. Girish Nayak, Chief Technology and Health Underwriting and Claims, Mr. Sandeep Koradia, Chief Corporate Solutions, International Bank Assurance, Mr. Anand Singhi, Chief Retail and Government Business, Mr. Gaurav Arora, Chief Reinsurance, Underwriting and Claims for Property and Casualty. Please note that any statements, comments are made in today's call that may look like forward-looking statements are based on information presently available to the management and do not constitute any indication of any future performance, as future involves risk and uncertainties which could cause results to differ materially from the current views being expressed. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance in the conference call, please signal an operator by pressing star then zero on your touch-tone phone. I now hand the conference over to Mr. Sanjeev Mantri, MD and CEO, ICICI Lombard General Insurance Limited. Thank you, and over to you.
Good evening to each one of you. Thank you for joining the earnings conference call at ICICI Lombard General Insurance Company Limited for Q4 and financial year 2025. Let me give you a brief overview of the trends we observed in the economy as well as the industry, followed by an overview of the business. Post this, our CFO, Mr. Gopal Balachandran, will share the financial performance of the company for the quarter and the year ended 31st March 2025. The GDP growth for the quarter ended December 2024 stood at 6.2% versus 5.6% for the quarter ended September 2024, as per the data released by MOPSI. High-frequency indicators like e-way bills, toll collections, diesel consumption, and GST collections during Q4 of financial year 2025 are all indicating positive economic conditions. Further, MOPSI has revised the full-year GDP estimates to 6.5% on Feb 28, 2025 versus 6.4% published on Jan 7, 2025. Let me now dwell on certain industry trends which can have an impact on the general insurance industry at large. As indicated during the last quarter, the government expenditure remained flat, which impacted the commercial line segment growth for the current quarter. However, we have started seeing an uptick in government spending towards capital expenditure in past few months. This may be a positive for the commercial line of business. For the auto industry, we had seen a growth in rural market in Q3 of 2025, specifically for two-wheeler segment at 12.7% and the tractor segment at 20.1%, as reported by FADA. However, in Q4 2025, we have seen a degrowth of 1.9% for the two-wheeler segment and a degrowth of 4.6% for the tractor segment. This indicates a softer rural demand. The private car segment grew by 1.1% and the commercial vehicle segment had a degrowth of 3.8% for Q4 financial year 2025, as reported by FADA, which had an impact on motor insurance growth for Q4 financial year 2025. However, for the coming year, the auto industry is expected to have mid-single-digit growth. We remain positive for the motor insurance business with increasing penetration in the old vehicle segment. The health segment continues to be one of the fastest growing segments and is the largest contributor to the industry, considering 38.1% of the GDP mix for financial year 2025. However, the industry growth in financial year 2025 was impacted due to the 1/n accounting norm and lower growth in the health benefit segment attributable to lower disbursement of credit by NBFCs and MFIs. We believe that the increasing demand for health protection coupled with increased medical inflation may drive double-digit growth in the health segment in the coming year. There were some key economic changes which were announced during Q4 financial year 2025. The budgetary announcement of income tax relief provided is expected to result in an additional 1 trillion in the hands of Indian tax-paying population, thereby leading to a high disposable income. The second consecutive interest rate cut, tweaking of norms applicable to NBFC lending, coupled with infusion of liquidity by RBI, should also support credit growth. These policy changes aim to encourage spending and investment. They are also expected to stimulate demand for goods and services, thereby boosting consumption and propelling demand for risk protection through insurance solutions. However, we remain vigilant on the ongoing geopolitical developments which may pose risk to both global growth and the Indian economy. Now let me give you an update on the regulatory developments. The authority during financial year 2025 continued with various reforms seeking to expand the market and increase the penetration of insurance products towards the mission of insurance for all by 2047. I would like to mention key circulars which were introduced in Q4 2025 regarding capping the increase in senior citizen health insurance premium rates to 10% per annum and introduction of Bima Esba facility for health insurance policies. We believe these regulatory changes will improve affordability and create operational ease for policyholders. Overall, we remain positive that the GI industry is poised to grow in the medium to long term given the favorable economic and regulatory environment, low penetration and relatively higher disposable income. Now coming to the industry performance for Q4 and financial year 2025. The gross direct premium income grew by 1.7% and 6.2% for Q4 2025 and financial year 2025 respectively. Excluding the impact of the 1/n accounting norm, the GDPI grew by 8.6% for financial year 2025. Excluding crop and mass health, the GDPI grew by 4.9% and 8% for Q4 2025 and financial year 2025 respectively. Speaking on the specific segments within the industry, the commercial segment reported a marginal degrowth of 1.2% and growth of 1.5% for Q4 and financial year 2025. Within this, the fire segment registered a degrowth of 1.8% and 5.3% for Q4 financial year 2025 and financial year 2025, respectively, on account of pricing pressure. Excluding the fire segment, the overall commercial segment grew by 8.5% for financial year 2025. The motor segment grew by 6.9% for Q4 of financial year 2025 and 8% for financial year 2025. The growth in the segment has been lower due to muted vehicle sales and continued pricing pressure reflected by high industry combined ratio. The health segment grew at 3.7% and 9% for Q4 2025 and financial year 2025. Within this, group health grew at 4.5% and 10.6% for Q4 2025 and financial year 2025 respectively. And retail health grew at 7.6% and 12.1% in Q4 2025 and financial year 2025 respectively. Looking at the underlying performance of the industry, you may recall our discussion a year back during our earnings call where we expected some semblance in underwriting discipline in the market due to improvement in the industry's combined ratio during that period. However, the combined ratio for the industry has actually worsened to 113.2% for 9 months 2025 as against 112.2% for 9 months financial year 2024. The combined ratio for the private sector has worsened to 111.21% for 9 months 2025 from 108.3% for 9 months financial year 2024. The industry worsening was largely due to motor segment combined ratio, which increased to 123.8% in 9 months financial year 2025 as against 118.2% in 9 months financial year 2024. Our continued focus on driving profitable growth helped us to improve our combined ratio from 103.7% in 9 months financial year 2024 to 102.8% in 9 months financial year 2025 and 103.3% in full financial year 2024 to 102.6% in for the financial year 2025 on N basis. I will now walk you through the company performance across key business segments during Q4 and financial year 2025. The company's GDPI registered a growth of 8% for Q4 2025 and 11% for financial year 2025 on N basis. With the 1/n accounting norm, For Q4 2025, the company registered a growth of 2.3% as against the industry growth of 1.7%. And for financial year 2025, the company registered a growth of 8.3% as against the industry growth of 6.2%. Excluding crop and mass health, the company's growth was 2.2% and 7.7% compared to the industry growth of 4.9% and 8% for Q4 2025 and financial year 2025 respectively. In the commercial line segment in Q4 2025, our growth was at 2.8% as against the industry degrowth of 1.2%. For financial year 2025, we grew by 2.1% as against the industry growth of 1.5%, thereby maintaining market share. This indicates the strength of our brand, relationship and service quality in an environment where the industry faced continued pricing pressure throughout the year. In the fire segment, we grew in line with the industry, and in marine cargo, engineering and liability lines of business, we reported growth higher than the industry, leading to market share accretion. In motor segment, we grew at 0.1% for Q4 2025 as against the industry growth of 6.9%. We continue to drive our motor strategy based on granular portfolio segmentation and prudent risk selection. For the financial year 2025, we grew by 11.5% as against the industry growth of 8%. Consequently, our market share grew to 10.8% for financial year 2025 versus 10.5% for financial year 2024. The portfolio mix for private car, two-wheeler and CV stood at 53.4%, 25.4% and 21.2% respectively. Our continued focus on multi-channel distribution, underwriting capabilities and efficient claim settlement and actuarial practices helped us in maintaining our leadership position. Moving to the health segment, we grew by 22.1% and 19.2% for Q4 financial year 2025 and financial year 2025 respectively. With the 1/n accounting norm, we grew by 9.7% and 12.6% for Q4 2025 and financial year 2025 respectively. Our retail health segment registered a growth at 47.7% for Q4 financial year 2025. With the 1/n accounting norm, the growth of Q4 2025 was 25.1% as against the industry growth of 7.6%. For financial year 2025, the overall growth stood at 38.1%. With 1/n accounting norm, the growth for financial year 2025 was 25% as against the industry growth of 12.1%. As a result, we gained market share from 3% in financial year 2024 to 3.3% for financial year 2025. The group health employee segment witnessed growth of 24.9% and 18.5% for Q4 2025 and financial year 2025. Respectively. Our group other business degrew by 5.5% and with the 1/n accounting norm, the degrowth was 30% for Q4 2025. For financial year 2025, group other business had a muted growth of 5.3% on account of impact on health benefit business through the banker channel. With the 1/n accounting norm, this segment showed a degrowth of 10.5% for the year. We had spoken about various One IL, One Team initiatives in our earlier earnings call. One of the initiatives we had spoken about was the consolidation of customer-facing digital assets like IL Take Care Help app, website and digital alliances under One IL, One Digital to deliver a superior customer experience and to drive efficiencies. Some of the digital outcomes achieved in financial year 2025 include increasing unique customer visit by 2x on our digital platform, 37% growth in fresh transactions on our digital platform, downloads for our one-stop solution One IL Take Care app surpassed 14.9 million. The business done through the app stood at 927.7 million and 2653.2 million for Q4 financial year 2025 and financial year 2025 respectively. Consequently, our customer-facing digital asset business grew by 15.8%, constituting 6.6% of our overall GDP for financial year 2025. Now I would like to share with you some initiatives taken by us for improving the customer experience and driving efficiencies for claims. On the motor side, our preferred partner network serviced 74.1% of our non-OEM claims in Q4 2025, up from 69.6% in Q4 2024. For financial year 2025, this number stood at 73.2%, up from 65% in financial year 2024. Our cloud calling facilities were used by 89.6% of our motor customers in Q4 financial year 2025, as against 77% in Q4 2024. For the full year, this number was at 86%, as against 49% previous year. This resulted in a reduction of calls to claim ratio by 21% for the year. Our average claim settlement period for retail lines of business has seen improvement from 6 days in financial year 2024 to 5 days in financial year 2025 for motor OD and from 5 days in financial year 2024 to 3 days in financial year 2025 for health. Our ICICI initiative, which was launched in April 2024, offered an on-ground claim support to over 90,000 customers across 56 cities and 2,500 hospital network in financial year 2025. Our focus on customer experience and process efficiencies has led to healthy NPS of 67 and 69 for health and motor claims respectively for 9 months 2025. With all the above efforts, we are pleased to share that the company's premium growth has been higher by 210 basis points as against the industry growth. Our focus on driving profitable opportunities has further resulted in improvement in the combined ratio from 103.3% in financial year 2024 to 102.6% in financial year 2025 on N basis. On the 1/N accounting norm, the combined ratio stood at 102.8%, leading to a PAT growth of 30.7% and a delivering ROE for the year at 19.1%. As we enter into the new financial year, we remain committed to achieving the desired scale through creation of positive customer experiences, leveraging data analytics, and a technology-first approach, harnessing our multi-product, multi-distribution strategy, and with a continued focus on product innovation. With our core philosophy of one aisle, one team, we continue to scale up the profit pools and to drive sustainable growth. I will now request Gopal to take you through the financial numbers for the recently concluded quarter and financial year.
Thanks, Sanjeev, and good evening to each one of you. I will now give you a brief overview of the financial performance for the recently concluded quarter and the financial year. We have uploaded the results presentation on our website. You can access it as we walk you through the performance numbers. With effect from October 1, 2024, long-term products are accounted on a 1/N basis as mandated by the regulator. Hence, Q4 and FY25 numbers are not comparable with prior periods. For more details on the impact, refer to slide number 15 of our investor presentation for further details. The gross direct premium income of the company was at rupees 268.33 billion in FY25 as against rupees 247.76 billion in FY24, a growth of 8.3% as against the industry growth of 6.2%. GDP of the company was at 62.11 billion in Q4 FY25 as against 60.73 billion in Q4 FY24, a growth of 2.3% as against industry growth of 1.7%. On the retail side of the business, GDP of the motor segment was at 107.4 billion in FY25 as against 96.34 billion in FY24, registering a growth of 11.5%. The advance premium for the motor segment was at rupees 37.17 billion at March 31, 2025 as against 36.44 billion as at December 31, 2024. GDP of the health segment was at rupees 69.5 billion in FY25 as against 61.71 billion in FY24, registering a growth of 12.6%. Our agents, which includes the point of sale distribution count, was at 1,40,736 as at March 31, 2025, up from 1,40,077 as at December 31, 2024. GDP of our commercial line segment was at 69.95 billion in FY25 as against 68.51 billion in FY24, registering a growth of 2.1% as against the industry growth of 1.5%. Resultantly, our combined ratio stood at 102.8% for FY25 as against 103.3% for FY24. Excluding the impact of cat losses of 0.94 billion in FY25 and 1.37 billion in FY24, the combined ratio was 102.4% and 102.5% respectively. Combined ratio for Q4 FY25 was 102.5% as against 102.3% in Q4 FY24. Our investment assets during the quarter rose to rupees 535.08 billion as at March 31, 2025, up from rupees 515.97 billion as at December 31, 2024. Our investment leverage net of borrowings was 3.74 times as at March 31, 2025, as against 3.76 times at December 31, 2024. Investment income was at 42.5 billion in FY25 as against 36.1 billion in FY24. On a quarterly basis, investment income was at 8.77 billion in Q4 FY25 as against 9.54 billion in Q4 FY24. Our capital gains net of impairment on investment assets stood at rupees 8.02 billion for the full year as compared to 5.51 billion in the previous financial year. Capital gains net of impairment on investment assets stood at rupees 0.06 billion in Q4 FY25 as compared to rupees 1.56 billion in Q4 FY24. Our profit before tax grew by 30% at 33.21 billion in FY25 as against 25.55 billion in FY24, whereas PBT degrew by 4.2% at 6.68 billion in Q4 FY25 as against 6.98 billion rupees in Q4 FY24. Consequently, profit after tax grew by 30.7% at 25.08 billion in FY25 as against 19.19 billion in FY24. PAT degrew by 1.9% to rupees 5.1 billion in Q4 FY25 as against 5.19 billion in Q4 FY24. The Board of Directors of the company has proposed a final dividend of rupees 7 per share for FY25. This payment is, however, subject to approval of shareholders in the ensuing annual general meeting of the company. The overall dividend for FY25, including the proposed final dividend, is rupees 12.5 per share. Last year, the overall dividend was rupees 11 per share. Return on average equity was 19.1% in FY25 as against 17.2% in FY24. Return on equity for Q4 this year was 14.5 as against 17.8 in Q4 of last year. Solvency ratio was at 2.69 times at March 31, 2025 as against 2.36 times at December 31, 2024. Continued to be higher than the regulatory minimum requirement of 1.5. As I conclude, I would like to assert that we remain focused on our strategy of driving profitable growth, consistent and sustainable value creation for all our stakeholders, while ensuring that the interest of policyholders is in the forefront at all times. I'd like to thank you all for attending this earnings call, and we will be happy to take any questions that you may have. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question comes from the line of Prayesh Jain from Motilal Oswal Financial Services Limited. Please go ahead.
Yeah, hi. A good set of numbers especially on the combined ratio front. Just your thoughts on, how do we see the growth from here? Firstly, from an overall GWP perspective, given the one-line impact would continue to be there in 1H of FY26, and second half would see unwinding of the GWP and contributing to some part of growth. So that would be the first question. Second question would be on your combined ratio, whether you would look at combined ratio further improving from the one that reported in the for FY25. And third bit on the fire segment, if you could highlight, what are the kind of renewals we've seen in January and also in the in the April renewals? And those would be my 3 questions. Thanks.
Okay. Yeah. Thanks, Prayesh. I think with respect to the growth, even when I was reading in terms of what it is line by line I had covered, but again I'll talk about it. Motor per se, we are expecting on the new sale mid-single digit. We are also going by the numbers as has been put across by other OEMs as to what they are seeing. Albeit the base on the private car in particular is high. I also spoke about the fact that the Q4 two-wheeler numbers were the negative, which was a bit of a surprise versus what we saw in Q3. And commercial vehicle, I would be more positive overall because government capex, a lot of other activities which in the last financial year had remained subdued should get picked up. So net motor, we will see single digit to maybe just about double digit growth is what our prediction is. And look, all of these things can change real time. We'll keep you updated, but that's what our belief is. On the health side, Prayesh, our own belief is we should see double digit growth. Now, health has 2 components, retail health and as well as the group health part of it. I'm more clearly talking about the retail health part, which will continue to see far more incremental business in terms of new to insurance, and also there would be whatever inflationary growth that comes out in terms of overall this. So we would remain positive on health, and health with a 38% contribution will not be surprised if we see that contribution probably going into a 40% and thereabout and becomes the largest and will continue to be the largest player. The last but not the least, in terms of the commercial line of business, we've had one of the most difficult years on commercial line if you see. We've never seen a growth of this nature going to, low single digit in last 7 to 8 years. Clearly, it had multiple factors, fire pricing, which we spoke about it. However, going forward, and you spoke about, and I'll probably talk about the other question that you put across, we saw a lot of semblance in the industry overall on the fire side. And on that basis, we do believe and we do see relatively much better numbers on fire, and with the activity on the capex which is coming through, engineering line of business should also do well. So overall commercial, we would like to believe that we should be back to a double digit kind of a growth at the industry level.
I think your last question was on the combined.
On the combined.
So I think Prayesh, again, if you look at what we have been saying is obviously our performance will be in the context of how the market performs. So which is why we kind of also put out as a part of the opening transcript, as in to say that at the beginning of the financial year concluded, we had kind of possibly expected a lot more semblance to pay out. But in reality, if you look at, I think the market seems to have gone slightly more, in that sense, north. I think combined ratios have kind of increased by almost about 100 basis points at an aggregate level. So obviously we will wait for the full year numbers to play out in terms of what the players report. But obviously we will be at it when it comes to, let's say, driving profitable opportunities. So hence the endeavor will be obviously to try and see how we can create a lot more efficiencies, whether it is on loss ratios, costs, etc., and obviously select the right portfolio mix. But obviously we will see how the market direction plays out, and in that context is how we would also want to see our combined play through. But having said that, definitely I think the gap between us and the industry combined, whichever way you look at it, I think obviously we will be able to kind of do a lot more positives to play out. And in the aggregate, I think what we have spoken about is time and again we will look for trying to see if we can do that improvement in the return on equity that we can give to stakeholders. The range that we have generally spoken about in that range of 16 to 18%. The endeavor will be to obviously try and see over the long term to move towards the 18 to 20 depending on how the market plays out.
Yeah. So I think, and also the simple answer is, would we like to improve our combined? Certainly yes. And as Gopal mentioned, we saw a trajectory when we came in last year, the industry combined had shown improvement. On the basis of that, we felt we will go. We also would like to see a similar thing, but the deterioration will happen, and the deterioration more so has happened in terms of motor moving from 118 to 123 for a 9-month combined. But so that being said, we will let these things play out, and in our mind, the single factor that drives is, are we able to generate the ROE? And that's what largely Gopal is speaking about it, as far as we as an entity is concerned.
No, that just your thoughts on motor TP price hike. That will be my last year.
So we always remain hopeful, but no news as yet. So is the industry seeking it? Answer is yes. If it come through, the answer is no. We are planning ourselves without a hike in that sense. Yeah.
Okay. Yeah. Thank you so much.
Thanks, Prayesh.
Thank you. A reminder to all the participants, in the interest of time, please restrict questions to 2 per participant. Next question comes from the line of Sanket Godha with Avendus Spark. Please go ahead.
Yeah, thank you for the opportunity. Gopal, in the current quarter, we seems to have done little more reinsurance accepted business because there is a meaningful difference between GDPI and GWP in the quarter, almost 10%. So just wanted to understand the color of this business and do you see opportunity in reinsurance accepted with price hikes going up? Probably you will do the same kind of a business in subsequent year also. Any thoughts on those lines? Just want to understand. And the second question, Gopal, was that if you could not book capital gains in the current quarter, your yield remained at 6.3. Suppose hypothetically market remains weak largely for FY26. So is it fair to say that your 6.3, 6.4 is the yield for probably for the entire FY26, and therefore we need to look ROE from that perspective? Just wanted to understand that a bit from you. And lastly, data keeping questions. If you can give retail health loss ratio breakup and motor GWP breakup into new and old, which you usually do. Thank you.
Yeah, maybe I think I'll first do the data keeping question first, which is something that keeps coming to us every quarter. So I'm just kind of giving you the numbers both for Q4 of last year and Q4 of this year first, and then I will give the numbers for the full year in terms of the breakup between corporate health and the retail indemnity numbers. So quarter 4 of last year, corporate health loss ratios were 88.1%, and the retail indemnity numbers again for quarter 4 of last year was 64.6%. Vis-a-vis this, quarter 4 of this year, corporate health is at 97.2%, and retail health, broadly the range that we have spoken about, is at about 64.8%. On a full year basis, this number for corporate health stands at about 93.7 last year, and the current year, again last year retail indemnity numbers is 65.4. Full year, this number for corporate health is at 97.6 and retail indemnity is 67.9. So that's the numbers in terms of the breakup between corporate health and retail health. Now coming to your point, first question on reinsurance accepted. One, at an aggregate level, obviously, if you ask us, underwriting philosophy is to drive profitable growth, whether it is with respect to the gross direct premium income that we write, or even with respect to, let's say, the reinsurances acceptances to the extent whatever we do. So therefore, from a philosophy standpoint, I think we will stand committed to driving profitable growth across the revenue streams that we source. Having said that, I think if you look at an aggregate level, I think in terms of the roughly the premium that we would have written of close to about 28,000 crores or thereabout, the extent of reinsurance inward will be a single digit number. So hence, to that extent, I think a large part of the opportunities is what we see clearly even in the domestic market. Plus, at the same time, obviously, we look for, given the fact that we also have an office in our IIO business, we would want to kind of continue to see how we can leverage profitable opportunities even through the IIO business. So hence, that is how we would kind of play through. Whether a particular business comes through in a quarter or otherwise, I think again, as I keep saying, our business is significantly cyclical, and wherever we see opportunities play out is how you will continue to see the mix of business between direct, RI, etc. play out. The larger number to look at will be more on an annual basis. That will be more reflective of where we are in terms of our approach to writing domestic and reinsurance inward. To your second point on... yeah, sorry.
So I was asking this question predominantly because you will see a better pricing environment in next fiscal year. So if other segments slow down, say motor slows down a bit because of the weak auto cycle, is it fair to say that this product might be an opportunistic approach to drive the overall growth maybe from that perspective? Because
exactly.
The pricing environment.
Exactly. So, Sanket, your point is absolutely right. That's exactly what I said. I think if you ask us, for us, both of them are preferred areas of opportunity. So, therefore, to that extent, where we see preferable segments for us to be able to underwrite, we will look at both. Will it suddenly become a very large proportion of our overall revenue streams? At this point of time, clearly not. But obviously, we will look at as I said, profitable opportunities between domestic and the reinsurance inward, and the revenues that we will eventually source will be a mix of both. On your point on capital gains, I think if you look at the approach that we have taken insofar as building the investment portfolio is concerned, I think the treasury team has done a brilliant job in terms of how to kind of balance the mix of asset classes between equity and the fixed income portfolio. And that's the reason during this last periods of high interest rate regime, we have been able to kind of significantly go long. And which is the reason, I think even in our earlier earnings call, we have spoken about of our duration of the book that still continues to be slightly in excess of 5.3 years. And if you look at the yield to maturity of the book also currently stands at about 7.55%. And hence, and which is what is kind of translating into, if you look at our mark-to-market positions on the overall investment book, while on the roughly an aggregate mark-to-market gain as on the balance sheet date of roughly about 18 billion in terms of the mark-to-market unrealized gains is what we have. So I think the portfolio is well positioned. The question to ask for is what happens in case if you see possibly sustained periods of price competition or sustained periods of low interest rate regime. Now all of that, I think insofar as the second part of, let's say, periods of low interest rate sustaining in the next year, I think to that extent, I think our duration call will kind of largely reflect that. And of course, reinvestment of the incremental cash flows will get subjected to getting placed at a lower interest rate. And that will be true for the entire market. So therefore, the entire market will have to work much more harder in terms of improving the pricing. And therefore, on balance, which is what we keep saying, I think the ROE range that we will work, which will be through a combination of driving underwriting outcomes and return on investment, that will be in the range of 18 to 20%, assuming the market obviously shows signs of change.
And also, Saket, now I'll just give you the, lay of the land. If you go back in time in April, as we were finishing our financial year 2024, if you would have told us to guess the growth rate for commercial line of business, we would have said definitely it will be in double digits. If you would have told us on the banker line of business, which is a big practice we have, again we would have said a decent mid double digit. But as transpired in the course of the year, both of these lines had a relatively difficult year. But again, the emphasis that we have as a multi-line, multi-product companies, are we agile enough to toggle? Even you look at the numbers that you see quarter on quarter in motor, we had a significant gain in quarter 1 and quarter 2, and again in quarter 3 and quarter 4, we have the PSUs which have built up severe intensity, which is not making much of an economic sense, and you have seen us growing relatively low while we have finished the year overall with a gain on market share. So what I'm trying to emphasize to all of you is what we see and what comes through, there can be a gap, and as an organization we are expected to maintain that level of agility to make those shifts happen, and what we predict not necessarily is the way the market will end up behaving. So we will have to factor that. And again, I come back, in light of that, the focus intently for us as an organization boils down to, are we able to generate the ROE that is expected by all our stakeholders. All right.
Good. Yeah. Motor growth.
Please rejoin the queue for more. Mr. Gola, please rejoin the queue for more questions. Sure. Thank you. Next question comes from the line of Nidesh Jain with Investec. Please go ahead.
Thanks for the opportunity. So 2 questions. First is on fire pricing. Are we already seeing signs of improvement in fire pricing for the industry?
Yeah, the answer is yes. There is some semblance, but I would like to put a word of caution because we still have to see a lot more flowing through. But as things stand in first couple of weeks of April, there was definitely much better discipline in the market.
Sure. Secondly, can you speak about IFRS impact on our profitability or ROE, any rough indication? Because some of the other companies are disclosing their IFRS number, which is also quite useful. So if we can also give some indication around that.
So Gopal will give the indication. My only point is, just to put things in perspective, there is an economic value and there is an accounting value. All these nuance changes are eventually on the accounting part of it. There is obviously an implication in terms of how positively IFRS can help us, but we as an organization would 100% commit ourselves on the economic value. Now, probably Gopal, if you can just talk about this.
I think we have actually kind of spoken this even in past calls. So therefore, I think our stance would still be the same, as in to say that I think we will continue to evaluate businesses more on an economic basis, because end of the day, that's what will eventually translate in terms of what is the outcome that we are writing from a risk perspective. Transitions to IFRS obviously are accounting changes, which we will be in that sense well prepared, and at this point of time obviously we are getting most of our work done internally, whether it is in terms of understanding the impact of change, getting systems geared up so that as and when there is a clear regulatory stipulations as what they have currently indicated. So we will be kind of pretty much ready with whatever it takes to do the transition. But at the same time, I think what I think we have been speaking about also is the fact that as and when we will eventually transition to IFRS, there will be a lot of, in that sense, assumptions which will have to be made by market at large. I think it is important for, again, various stakeholders to ensure consistency in comparison, a need for possibly to see if we can get a lot more alignment with some of those assumptions that the market participants use. So I think our endeavor is in that direction, and which is what we are working with the council to see how we can possibly play that role far better at this in the current times. But obviously internally we are pretty much well prepared. Major areas of impact I think I have already called out, so in that sense no specific incremental areas to call out as a part of the current impact assessment that we have done. But yes, we are ready, and we will roll out whenever we see the regulatory timelines coming into action.
Okay. And then when we speak about economic perspective, we are talking more about ROE and not combined ratio, right?
This is the operator.
Yeah, because end of the day, I think whatever you write has to kind of translate into a return to stakeholders through a combination of what we deliver on underwriting plus obviously how effectively are we able to put the cash flows to use. So hence to that extent is what we will kind of be largely driving as an institution.
Thank you, sir. Thank you. That's it from my side.
Thanks, Nidesh.
Thanks, Nidesh.
Thank you. Next question comes from the line of Avinash Singh with Emkay Global Financial Services Limited. Please go ahead.
Yeah, hi. Good evening. Thanks for the opportunity. Just a couple of questions. First one is on motor TP. If I see again around 915 odd crores of reserve releases you had this fiscal. Now, of course, still you have not touched your FY23 onwards. If I see, Now, the backdrop is that the price hike is not happening. Do you see, the support from reserve releases to continue to provide, the support in terms of a motor TP claims ratio to catch up with, the claims in place? And then on that front, also another question related is that, industry has seen the kind of despite this EOM coming, the overall non-claims expense going up. Now, do you see that scope next year if the claims were to be under pressure, OPEX side, because now the March 26th deadline for EOM limits reaching some kind of sanity prevailing among some extreme or aggressive peers? Would that lead to your OPEX further improving from here? Because at the end of the day, that's a sort of a market-related phenomena. You cannot outprice yourself in the market. So if the peers were to improve, will that also be kind of helpful? And the second one on the April 1 renewal, if I read correctly, India, even in Asia, the reinsurance capacities and pricing both have been kind of favorable. So in that backdrop, does that sort of help in terms of your profitability in these kind of reinsurance heavy line item like commercial lines? Thanks.
Okay, so maybe I will take the second part first. I think what you observed is absolutely right. So hence obviously that aids us. Which is what we have been kind of talking through. I think the more the market gets sensible insofar as the need for compliance to the expense of management guidelines are concerned, that kind of definitely augurs well from an overall market discipline standpoint. So, and therefore, and again, as you rightly indicated, FY26 is the time period that the regulator has stipulated within which companies are expected to toe the line when it comes to meeting the guidelines on expense of management. So obviously, this is something that we would be definitely kind of closely watching for. But at the same time, I'm sure all of you are also kind of clearly hearing that even the regulator is wanting to make sure that as an industry, pretty much everyone in the market kind of follows the discipline on compliance to expense of management. So hence, the short answer is, of course, it augurs well insofar as favorable market development is concerned. And within that, indeed, obviously, that's something that we have always seen. When the market gets far more sensible on underwriting, then ICICI Lombard, by virtue of its brand, technology, service, etc., is obviously able to kind of command an incremental market growth without compromising on underwriting outcomes. So that's the response to the second one. To the response on the third one, I think with respect to the reinsurance renewal cycle, again, Avinash, I think you all understand insurance as much as what we do. So therefore, in that sense, the renewals are always through cycles. You will always see periods of softness, and at some points of time, the market starts to get hardened. I think the key is, end of the day, I think if you look at from our standpoint, what we have again, particularly in the commercial lines, where you relatively see higher proportion of reinsurance, we have continued to stay disciplined on picking risks which we think are viable from an underwriting perspective. Irrespective of which cycle the market is currently operating at in terms of the reinsurance renewals. Now that's what is finding favor if you were to see, which is what put out also on our investor presentation, as in to say that the quality of the partners with whom we work clearly is kind of pretty much there. So obviously we don't, in that sense, want to take any unnecessary credit risk. So we are very, very conscious of making sure that we work with high quality panel of reinsurers. So that gives us a lot of comfort when it comes to getting capacity. And also, now to your point on terms, obviously it's again we get terms which are better than the market. So even this year, at least what we understand relative to the market, I think we have been given the underwriting performance that we have exhibited to the reinsurers. I think we believe we have been able to get terms both on commissions and the cost that we incur for protecting our net to be possibly better than where the market is placed at. And that will again kind of aid us in our ability to further dwell on incremental market share. So that's in response to the third question on reinsurance renewal cycle. To your first point on motor third party, I think again, I keep saying this. I think the ranges is what we have spoken about in terms of the motor loss ratio. Again, I will keep saying we have to look at motor as in the aggregate, and the range that we have spoken about even in the earlier earnings call for the segment has been between 65 to 67. Broadly, if you look at the loss ratio outcome that has played out for even the current year, is pretty much within the range that we have been kind of talking about. So hence, that's how we look at. Now, what can happen in case if no third-party price increase sustains for one more year in FY26? Obviously, that means we'll have to do a lot more work to make sure that we are able to identify better risk selection and continue to see how we can drive profitable growth. That's what we will focus on. And more importantly, let's say for the market, they will have to work much more harder, particularly for those companies which have combined with no third-party price increase and a compliance to expense of management.
Yes,
is something that some of those market participants will have to work on. So again, we believe again favorably placed in terms of the opportunity that one sees on motor third party. And finally, on the point on reserving, I think again our approach to the actuarial principles pretty much stands intact. There is absolutely no change in the way how we have been kind of reserving for the portfolio in terms of consistency. And that's the reason even if you would have seen the reserve redundancy that you would have seen across key lines, we continue to see one more year of reserve redundancy. So that reflects the quality of reserving that we have been able to kind of play up to. So hence no change in the actuarial thought process.
Thank you. Very clear. Thanks.
thank you.
Thank you. Next question comes from the line of Shreya Shivani with CLSA. Please go ahead.
Hi, thank you for the opportunity. I have one question that is on the expense ratio for the quarter. So the way I understood the impact of the 1/n accounting last time, the quarters are similar in terms of what happened in 3Q to 4Q in terms of the volume growth that you got or how much you have retained. Then ideally your expense ratio should have been similar to what it was in 3Q. Even the absolute amount has declined in 4Q. If I don't talk about the ratio, even the absolute amount has declined. So what has helped us in having much lesser net commissions, at least if you can help me understand? This is just about the quarter.
So Shreya, again, it's like the question that keeps coming to us in terms of the third party loss experience on how the loss ratio movement are happening between quarters. I think again I will kind of keep reiterating. I think our focus is very clearly is to make sure that expense plus commissions put together as a company, we are very, very conscious of making sure that we run the overall operations at a EOM threshold which is less than 30%, and which is what, if you see on a full year basis, I think for us the expense of management number stands at about 29.5%. So hence I think we are pretty much committed. Within a quarter, various factors in terms of business mix, in terms of efficiencies that we always keep looking for in terms of our own internal processes, and so there are numerous factors that go into it. So hence, which is why we keep urging to keep looking at numbers more on an annual basis rather than a particular quarter, and more so on an absolute basis. I think again there can be many factors to it. So for example, I mean, if there are periods where I do a lot more of those investments in that quarter, you will see the cost hitting us, and so on. So a better number to look at will be more the expense of management number than anything else.
No, and also shares, I mean, since you're comparing quarter 3 and quarter 4, just to highlight, it's the configuration of business that comes in. In quarter 3, we have far more new book that comes in. It's a season where, the sale of new goes, our market share in motor also grows in a very, very significant way. In January, typical Jan 1st also is a reasonably big line on the commercial side of the business, which can further impact the expense ratio in a positive manner. So it's more driven by configuration of what nature of business you write, which creates the differentiation. And then that's what, and that when these things happen and you have a quarter where there's a new coming in, it would impact us in a far more, Okay.
Yeah, the only thing I was getting confused that if the retention ratios are similar between 3Q and 4Q, then your commission rates should have been similar, ideally, your net commission ratios. But I get the part that if you've written more commercial line in 4Q, then obviously. Yeah.
Okay.
Fair.
Okay, thank you.
Thank you.
Thank you. Next question comes from the line of Prakhar Sharma with Jefferies. Please go ahead.
Hi, good evening. Just wanted to delve upon Sunil's comment on, the pricing stance by some of the PSUs or broader market in the motor vehicle business. Could you just elaborate on this that, from what segments of general GI operators did you see some bit of an aggressive stance, and has there been any change? Because while we talk about the EOM sunset for FY26, are the private ones also genuinely trying to consolidate on pricing? And second, just connected to this is there a possibility or is there a discussion around the EOM getting pushed out by a year or so, just so that everybody makes it without too much disruption? Thank you.
So Prakhar, I think on the PSU aggression, it's primarily driven very extensively on the motor side. Will it sustain? Too early to comment. There were shades of that visible in quarter 3, but quarter 4, if you see, they have overall buckled the trend and they've gained significant market share also in the motor segment. It would be anybody's guess in terms of what their plan is. We are pretty ready to face whatever be the trajectory that they have, and we'll wait and see how it pans out. We would continue to, as I said in my initial remarks, that we would continue to flow prudently because these things can happen at multiple levels with multiple players. sometimes it's private sector, sometimes it's public sector, but we need to stick to our trajectory of what we want to do. With respect to expense of management deferment, our understanding is that what has got called out was full and final. We do believe it will be good in long term for the industry if there's a semblance on that count. We are no one to comment in terms of whether a dispensation will be given for another year. But if you ask a personal belief, another year of dispensation will make them continue the practice as it exists and will not change anything, because then they can ask another year of dispensation. So that's where we would be, that's where we would leave this part of the conversation at least.
Perfect. Thank you so much.
Yeah, thank you.
Thank you. Next question comes from the line of Aditi Joshi with JP Morgan. Please go ahead.
Thank you for taking my question. Just a very simple one. Sorry, could not go through the presentation. With respect to the investment income, was it in the fourth quarter it was lower on a year-on-year basis? I just wanted to understand, is it majorly on account of interest income or on account of lower realized gains?
Yeah, we put that as a part of the opening script, Aditi. So largely it's because of, the nature of how we the nature of how we run the overall investment book. The short answer is capital gains. Quarter 4 last year, capital gains was roughly about 150 crores plus. This year, pretty much our capital gains is as good as a very, very small number of roughly about 6 crores. So that's the reason why you see the overall investment income for Q4 of this year to be slightly lower than the Q4 of last year. But having said that, I think what has worked well, again, as I said, I think the treasury team has done a great job in trying to make sure that the portfolio has got significantly kind of balanced to make sure that we go long. And hence, which is why again, time and again, we have been giving the yield to maturity numbers, which used to be less than 7%. That number as we speak currently stands at about 7.55%. So this is for here to stay. And hence, at least for quarter 4, the short answer is capital gains.
Yeah, and also, something which I must put across, what our treasury team has done is even over quarter on quarter, we have increased the yield of the book from 7% to 7.55. So which is a big one with a tenor also, which has gone to 5.34. Overall, it puts us well in terms of the current scenario that exists on the interest rate part. And also in quarter 3, it was more of a tactical call where our investment team felt that it was much better to book capital gains in that quarter vis-a-vis what would happen in quarter 4. In hindsight, it did work out for us.
Okay, that's clear. Thank you.
Thanks, Aditi.
Thank you. Next question comes from the line of Neeraj Toshniwal with UBS Securities. Please go ahead.
Yeah, hi. My question is regarding getting to FY26. How should one think about the growth, given, whatever we have discussed, there are still going to be a lot of uncertainties, as you mentioned, and the playbook could be different than what we think about as...
Neeraj, sorry to stop you. We are not able to hear you. You're not that audible.
Is it better now?
Yeah, maybe if you can just repeat your question, Neeraj, that will help us.
So one question is on the growth side, because given this online will kind of normalize from October, how should one think about overall growth, and the preferred areas will remain health, and obviously motor, there's been a lot of competitive intensity which is, increased, especially from PSUs, what I understand. So any comment on overall growth we are targeting in FY26? That is one. And second is a bookkeeping question on the other income from the non-operating results, which seems to be very high. So anything on that?
So maybe I'll take the first one. I think on the growth side, Neeraj, the good part is, I think if you look at some of the actions which are being taken, both at various governments and even our own insurance regulator, I think the efforts have been very, very positive. I think, for example, the recent budget did see a lot of people kind of getting a higher disposable income, which kind of augurs well. Now all of this will start to kind of play through maybe over the subsequent quarters. So that's a very, very positive action which comes from the government. Equally, I think regulators are doing their part in terms of trying to keep relatively the interest rate of the environment at far more acceptable levels, and the very recent rate cuts again kind of augurs well insofar as driving retail consumption and in general driving consumptions are concerned. So there are clearly a lot of positive factors which should aid when it comes to, let's say, growth, because ours is a direct reflection of what happens insofar as economic activities are concerned, and some of these positive actions by the government and regulators augurs very, very well. Coupled with this, I think if you look at relief side for the next 2 quarters, in general, I think we are very, very positively placed in terms of how we see the opportunity play out, and also what we kind of responded to the earlier question on how the initial corporate renewal cycle has been. I think that looks again very, very promising. That's something that has started off on a positive note right from the beginning of the year. So hence, even for the rest of the year, one should see that cycle play through. So overall, I think we are kind of positively looking at in terms of how the market should kind of play out. And within that, I think what we have spoken is to try and see how we can continue to deliver that outperformance vis-a-vis the industry growth numbers is what we will be kind of penciling in. First 2 quarters, you are absolutely right, Neeraj, in terms of the impact of 1/n will obviously kind of play out. So maybe to that extent, industry growth could be a little subdued, but on a full year basis, I think we are very, very optimistic.
And any comment on the combined ratio guidance? If we are changing or revising or giving any new guidance?
I think we are, see on the guidance part, we've given a complete perspective. If the industry continues to deteriorate, our own belief would be that we are part of the same pond, right? So you would see overall challenges, but in our scheme of things, if there is improvement status quo, you would see us probably improving. More importantly, it's the ROE part of it which we would focus on and see what kind of returns we are able to generate, and in that we've always maintained that we want to see at least a 16 to 20% kind of a range for us as a company being given to stakeholders.
So last one on the bookkeeping of the other income on the non-operating results seems to be very high. Is it something regrouping, or if you can throw some?
Yeah, nothing specific, Neeraj, but it is business as usual for us. They will all be driven by whatever the regulatory stipulations are, and no specific changes per se.
Oh, thank you.
Thank you. Ladies and gentlemen, due to time constraints, we have reached the end of question and answer session. I would now like to hand the conference over to Mr. Sanjeev Mantri for closing comments.
I think great to connect with all of you. Closure of another financial year and some exciting times of it. Look forward to interacting with each one of you as and when your time permits. We do believe that general insurance industry is poised for a decent year going forward, and we would keep in touch and keep you updated. Thank you so much for joining in, and all the best to each one of you.
Thank you so much.
Thank you. On behalf of ICICI Lombard General Insurance Company Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.